Welcome, everyone. I'm Angelo Robles to the Angelo Robles podcast. I'm also the founder and CEO at Family Office Association. What we look to do on the podcast is distill the best practices and best ideas of among the world's most successful investors, families, and their family offices. I hope to provide thought-provoking opinions and feature amazing guests to our listeners and viewers of the podcast with an eye towards the future of investing, successful families, and their family offices. Today's session is titled Legendary Trader Dan Tapiero discusses how gold and Bitcoin can both thrive. Many of you are already familiar with Dan, and he has an extraordinary background, which I am going to ask him in a minute or so to give a quick recap of. But when you have traded under and have been around people like Julian Robertson, Michael Steinhardt, Steve Cohen, Stan Druckenmiller, I'm in Greenwich, Connecticut. I'm in the so-called hedge fund capital of the world. I've interviewed some of the people that I just noted, and I don't know anyone that has not only worked with the volume of amazing people, but has carved his own path and has been incredibly successful. So it's really great to have Dan Tapiero, macro thinker, investor, and co-founder of 10T Holdings and co-founder of Gold Bullion International. Dan, welcome to the show.
Hi, glad to be here.
It's really a pleasure. I do want to get right into it, but that background that I noted is just so extraordinary and special.
Oh.
And I think it will help frame as a macro thinker how you think and how you made decisions and how active you've been in looking at both gold and Bitcoin. If you don't mind sharing a little bit of your background, I almost never ask that question because usually it's boring, but in your case, it's not boring. I'd love to listen.
Well, it's definitely been very colorful. And I definitely took the route of, try to learn under as many great mentors as possible, experience and push yourself as much as possible. Of course, these guys are, all very intense. You're working down there in the bunker very closely with them. So, these are not, at least when I was there, they're not large organizations. So, tremendous learning experience over the period that I worked for those guys. Yes, in the early 90s, I basically started out my career at Tiger. I was very young then, working with two guys in the macro group, two senior guys, and we had a fantastic run. And again, my education about macro and what it was really learned from Julian, and then of course the two guys, David Gerstenhaber and Barry Rosano. Again, that's early 90s, and we were involved in the RM crisis and all these European trades. And it was great to be such a young guy and just to see how someone like Julian operated, the type of risk that he took, how he expressed it, and really the amount of research that went into those ideas. And again, I was naturally sort of very research focused. I'd studied history at Brown and did a BA and MA, and, was used to writing 20, 30-page papers, sometimes late at night. And so that sort of very exhaustive research process sort of, I saw how it was done at Tiger, and that really, that's been sort of the base of my career, at the base of my career. Eventually left with those two senior partners and formed a company called Argonaut, which unfortunately didn't last that long. The two senior partners basically decided to part ways, and I left with one of them to work for Michael Steinhardt. So I was the head macro strategist there, and that was a different sort of style of trading and investing than Tiger. Very interesting, much more trading oriented, but also, Michael was very interested in sort of where the rubber meets the road, and looking for immediate catalysts, which was something that I wasn't really as focused on at Tiger. So that was a fascinating experience. Eventually then went to work with Steve Cohen at SAC in the early days. It was around 99. And I was the first macro person that he had hired. It was an equity trading firm. And Steve gave me a lot of freedom, had a relatively large portfolio, eventually allowed me to raise outside money, and I launched DTAP Capital in 2003. And that money was run pari passu with my SAC money. But also, was close with Steve, eventually, sat next to him for a while and was his sort of, I would say, his macro advisor on, all things macro, how they would pertain to things going on in the firm or his portfolio. And again, that was a completely different experience. Steve is an equity trader, not really as versed in the macro. So there was a large sort of value add component there. And, Steve actually was very easy to work with and quite fun. I know some people, at least in the old days, his reputation wasn't as such, but I think it was wrong. Very easygoing guy. And I think we sort of see that as owner of the Mets. He's now on the Twitter and he's cracking jokes, and that's sort of who he is. I think people will get to see him for who he is. But I had a great experience there. Eventually left in 2006 to work with Stan Druckenmiller. That was I'd always wanted to work with Stan or George Soros, and Stan was at Duquesne, and just an opportunity opened up, and went to work with Stan and had just a phenomenal experience. I mean, he of course is the greatest macro trader, certainly of his generation. I think along with Soros, the top two guys of all time. And again, that was really groundbreaking for me. I could see how he positioned his portfolio, again, very research oriented as well. To be able to watch him invest and trade and really be up close in the nitty gritty. I also ran my own portfolio there, but that was really super exciting for me. But importantly, it was also Stan who showed me that you could take a macro idea, and all the research that we had done at the time, we were very focused on agriculture, had quite a big position in the grains. But he showed me that you could take an idea that you'd done work on, and again, I had 4 analysts at the time, and apply that to a different area, or apply it in a different way. And we launched in 2006 a company called AgCoa, and AgCoa eventually became the largest private farmland REIT in the US. And in 2013, ended up selling that to CPP, the Canadian Pension Fund System. Funnily enough, last year, Bill Gates's Cascade bought all of those farms from CPP. So they're, but interestingly, I learned from him that you could do that. And that sort of led me to my next venture in 2008, 2009. I launched a physical gold company with a partner. I was trying to find a way to own physical gold outside of the banking system. I was really concerned about systemic banking problems at the time. And I just thought, like, why would I own a physical bar and have it stored in a bank when it was acting as a hedge against that bank potentially going under? So couldn't really find a legitimate, great way to do that, and launched GBI, Gold Bullion International, in 2008, 2009. And thankfully, with my co-founder and who still is the current CEO, we've grown that business. We're the 3rd largest vaulter of gold in the world now, outside of the banking system. We vault in 7 different places around the world. Again, leasing space from Brinks and Loomis. We have over 300,000 clients. We've done over 1 million trades, 40 employees. So it's really grown into quite a company. And I've been on the board, of course, and retain a big chunk of ownership of that company. I still think that, the goal that we set out, which was to make it easy for people to buy and store physical gold, silver, platinum, palladium. I mean, I really think we've made tremendous progress in doing that. I think, and of course, this year has been a phenomenal year with the uptake in gold prices, but also in interest. And we can talk about that a bit later. But funnily enough, it was through that gold company that I first learned about Bitcoin. And in 2014, GBI integrated with a firm called BitReserve, which today is the Uphold wallet. And we were the first place, at least that I'm aware of, that allowed people to buy and sell physical gold, to buy and sell Bitcoin and Ripple. And you can still do it today. Unfortunately, that business line never took off. We never really marketed it, but it still exists today. And so that was my introduction. And I have to say, Bitcoin, is something that's complex, hard to understand. And I didn't quite get it really. And it was sort of in my purview. I was watching it, didn't quite get it. And it wasn't until 2018, 19, after Bitcoin had gone up to 19,000 and come back down to around 4,000, did I realize that, like, okay, now I've really got to focus on it. Because, as an old time macro guy, that if something goes up a ton and comes off 85%, that it's either a bankruptcy or it's a massive buying opportunity. So I just started buying in my own entity, DTAP Capital. And I just got sucked in. The more that I bought, the more research I was doing. And then frankly spent about 6 months, I'd say really 10 hours a day, reading, listening to podcasts. There's a very lively, active, vibrant community on Twitter. They're very happy to, bring people in to teach people. Read probably 10 books, hundreds of articles, and then realized that, this was an opportunity that was massive and something that I wanted to focus on for the next sort of 10 years or so. And so that's sort of how my macro background kind of brought me to gold and then Bitcoin, certainly from a career perspective. It did help that the macro fundamentals, again, we can talk about that in a second, the central bank balance sheet expansion and the response to COVID sort of kicked things into a higher gear. But again, I've just been going on there for a little bit, so maybe I'll pause.
I wanted for a change to be quiet and just listen, because that background of yours is amazing, and what you've accomplished with, co-founding Gold Bullion International that I've known about for over 10 years. I have members in my organization that have purchased gold through it and are nothing but pleased. So, kudos to you. You said something, and we are going to get to the big macro picture in a second. You said something to begin with Julian Robinson that caught my ear, and that was effectively his appetite for risk. That's always exciting to see, but in practicality, you can make a lot, you could lose a lot. And that may relate to the fallacy of having too many different investments and being too diversified versus being much more strategic, making fewer bets, but the opportunity that those could really, really, really pay off. What did you learn from Julian from that appetite for risk?
All right. Yeah, we talked about that briefly before. Well, it's just that, sort of the old school macro guys were focused on return. Today, I think the hedge fund business largely is more of it's almost a cash management tool. Many of the hedge funds, no, it is. The top 1% of guys will always make money. They're always going to be focused on return. I think largely the bottom 80% or whatever the number is, they're really focused more on growing assets. They've become more sort of traditional money managers, more concerned with, losing their assets and actually return. And in those early days, 90s and even the 2000s, macro traders, macro investors, guys, again, who are a little more advanced in their career. I mean, Julian was in his late 60s when I was working for him, wanted to make as much money as possible and maximize on the opportunities. And so they had the luxury of doing that. But that was also, the investment style. And of course, Stan famously, says, he likes to put all his eggs in one basket and then watch that basket very carefully. And, I wouldn't necessarily say that I'm in the same category, but I do think that, look, when there's a very big macro trend happening, you need to focus on it because, there aren't 10 of them per year. It's not like being a long short equity manager and, you have specific stock bets that you're interested in. These are really big trends. And when they happen, you really need to be there. And in the early 90s, we were very focused on European fixed income and European currencies. And that was just, and that was the focus of the portfolio almost exclusively. And so the fund was able, to make huge returns because, he wasn't concerned about diversification. He wasn't concerned about any of that. A big chunk of the money in the fund was his own and his friends. And the point was, to maximize return. And so I sort of come more out of that background rather than the background of a guy who is interested in making 1% a month with no volatility. I mean, that's just not anything I have a skill for, not anything that I'm interested in. And I think a large part of the hedge fund business today is really, as I said, more about minimizing volatility so that they can grow their investor base to live off the fees. And look, that's a great business model. It's just not anything that that I find interesting or that I could do well. So,
and that whole concept really came down to in the early 90s, institutions, mainly pensions, starting to get involved in hedge funds, putting in huge amounts of money, more than single family offices do, and then looking to dampen volatility, cut the you-know-what off a manager, but the manager's getting 2 and 20, becoming a billionaire. It's a trade-off that they made, but they make boring guests. Dan, an inside joke among us Greenwich folk, we got to be a little careful what we say about our brethren in the hedge fund community. We'll never be back allowed in polpos again.
Well, no, I mean, look, I know most of those guys, and I think most of the guys who've been around for 25, 30 years would agree. Look, and as I said, I think the very best hedge fund people will always make return, and sometimes very big return. And as many of those guys are in Greenwich, right? And many of them are my friends too. So I'm not really talking about sort of the top 1 or 2 or 3% of the people. I think the hedge fund business as an industry is not something that is growing anymore, is basically what I would say. And sort of the greatest alpha that I've ever seen and the greatest risk reward, most asymmetric bet I think that I've seen in 30 years is on Bitcoin and what I would call in growth in the digital asset ecosystem, the DAE.
Well, then let's get right to that. And by the way, for those that don't know, Polpo's is the best Italian restaurant in Greenwich. Okay, enough about Polpo's. Let's set the macro picture. So modern monetary policy, central banks, printing money, the dollar, this is all going to play into gold and Bitcoin. Give us an education on all of that and how that relates to your decision to allocate heavily to gold and Bitcoin.
Yeah, I mean, look, I think, it's become a little more obvious in the last 2 to 3 months. Bitcoin is up 500% from March, right? At 24,000, it probably traded down to 5. The move from March has been tremendous. And again, driven by central bank balance sheet expansion, the growth in M2 in the US, which is around 25%, is probably the most important breakout sort of statistic of the year. Of all the macro statistics, just because if you look at that chart going back 30 years, M2 growth has been in a 0 to 10% range, and all of a sudden you've spiked up into this 25% area, and it's still it's being maintained at that pace. And again, it's not just the U.S., it's central banks all around the world, and also governments around the world, and it's mostly in response to COVID, which, has certainly shut down many industries around the world, put a lot of people out of work. But COVID has actually also accelerated a lot of good things. I think that productivity enhancements that we've seen are going to be permanent. I don't think this story has been discussed yet, but I think it will be in coming months, that the amount of work that can be done, the amount of time that can be saved, even just something as simple as Zoom is just incredible. I mean, if you think about the money management business alone and raising capital, I mentioned to you earlier that we're raising this fund, 10T Holdings, and I was supposed to go to Australia in March, and I was going to meet 20 investors. And so I was going to go down there, do lunches and dinners, stay down there for 2 weeks, hotel, flight, everything, have some colleagues join me in the capital raising process. And basically COVID canceled it. And what ended up happening was that I ended up in August having one call for 1 hour, and I hit everybody, and we had a very high success rate. And so if you just think about how much time and energy, and I would never be able to hit that many, investors. And we did 1 hour, one presentation. And so I think that there's something permanent about these changes now that people are, we don't love it. We prefer to do meetings in person. But if you think about how this is sort of, if you could extrapolate that throughout the entire economy, how much benefit there is from work from home, I think it's part of the reason that the stock market, has been as strong as it is, that all of these efficiencies, productivity gains are going to continue to drive GDP growth. So it's not just that they hit the world with so much stimulus. Also, look, zero rates is a big deal. Now, we've had them in Japan and Germany for a while, negative rates there. But having rates basically at zero and the bond market at, basically, 20 to 60 basis points, the entire US government bond market, that's also been a huge incentive, a huge a reason for money to flow into gold and both Bitcoin. I'm just trying to think, other specific macro factors. I mean, there are plenty of them. But, since I just mentioned the bonds, let me just highlight one thing. I mean, I do think the most important decision that every family office, that every investor needs to make over the next 10 years, in the 2020s, I say, is the decision about what to do with their bond allocation. Because this 70-30, 60-40 portfolio, which has worked so brilliantly since 1981 or 82, is basically not going to be able to function the way that it has. And I say that because historically, every time you had a slowdown or every time the US equity market had a hiccup, your bonds saved you. I remember 2-year notes in 2000 were at 6%. And, so when the NASDAQ blew off and corrected, you had 600 basis points. And, I'm not saying that, we're having an equity market correction here, or I'm not making any claim like that. But the point is that 30 to 40% of your portfolio, which was a hedge, which did work and did buffer your portfolio when the equities went sideways or when we had a recession, is now neutered. It's now gone. And, because I don't think there's an ability for bonds to go below zero and to really help your portfolio anymore. And I think owning bonds with negative yield doesn't make any sense for anyone. So even if you've jumped up the risk curve a little bit and decided to allocate to some corporate bonds, maybe they're 1%, maybe they're 1.5% or 2% yielding, I don't know. But if things do slow, if we do have a period that gets a little rocky, the Fed has to come in again, take rates even potentially negative, add more liquidity, your bonds are not going to help and your equities are going to go sideways or suffer. And I think that gold is the only liquid defensive asset available. And so I think over the next 5 to 7 years, the gold price can double, maybe even do a little more. The supply is constrained. I don't see that much supply coming on stream. Of course, the longer the prices are up here, the more profitable the miners are, the more supply they'll look to find. But it's relatively tight. And, you know, if you're a big institution or a big family office and you're sitting with 60, 70% equity, you really don't have a hedge at all. And gold is great because it can work both ways. You know, if things are going okay, like they have since March and the economy is rebounding, as long as there's a lot of liquidity, you're going to get a bit of it flowing over into gold. And gold has had a, you know, good 20+% year. Has been very solid with the equities doing well. I think in a period where the equities don't do well, gold can still do well. And so I think that when we look at institutions, they've only allocated 1 to 2%, if that, to gold. Most institutions have zero allocation. I really think this is the beginning of sort of a glory phase for gold as institutions realize we need to replace some portion of our bond allocation. I'm not saying you replace it fully with gold, but I think, you know, 5%, you know, even 10%. I mean, we know Ray Dalio at Bridgewater has had 10% for a while. You know, Tudor Jones and Druckenmiller both talked about gold positions, have talked about their gold positions publicly. So I think that for larger clients, I think you need to have that in the portfolio. Bitcoin, I also think should be in the portfolio. There is a defensive component to it. It's done very well since March, of course. It's a scarce asset, so it does well when liquidity is plentiful, when central banks are printing money, money supply is going up dramatically. But, you know, Bitcoin is also a super offensive asset. And Bitcoin is also something I think that is really much bigger, actually, than gold, because Bitcoin is not just a store of value. Bitcoin is an entire network. And the invention of Bitcoin, and I've said this before, I think is an invention akin to the invention of the combustion engine. It's a discovery like the discovery of electricity. And we've talked about this briefly before. I think, you know, people don't understand that that 8-page white paper that was published by Satoshi is the result of 30 years of scientific and cryptographic research. That is not a hokey thing by some person, written by some person who we don't know who it is, by some Japanese guy. It's probably written by a handful of, you know, of these cryptographers who are cited in the white paper. And that white paper solves a math problem that had not been solved for many, many years called the Byzantine generals problem. And that's the problem of distributed trust. And what that is the contraption, the machine, the mechanism of Bitcoin, you know, is such that it's created a method for two counterparties to trust each other, to transact value between each other without an intermediary. So, you know, this is something that's completely new. It's a vast global network. It's decentralized. That's a lot bigger than gold, which is an asset, right? And a store of value that probably has the greatest network value of, you know, of certainly of any asset. And there's certain Bitcoiners out there who think that gold is going to go away. It's going to be replaced. You don't replace something that has the greatest network effect of any asset in the history of the world. I mean, you know, people know, you can go to any person in the world, anywhere in any country. They know sun, they know water, they know light, you know, they know earth, and they know gold. Okay. And I think that it is that kind of thing. I think Bitcoin though is very difficult to understand because that network is extremely complex, how it's built. And I would say to people listening and to you too, that like we have an engine in a car and we know the engine drives the car, but none of us could actually take apart that engine piece for piece and then put it back together. And so, you know, what Bitcoin is, to really understand how it works, is to be able to take that engine apart. And so I think that we're now at a place where people are saying, I don't need to know that. I can understand lots of, you know, things about it that make me comfortable to allocate some percent of my portfolio to Bitcoin. Because one day, and this is the last thing I said, and again, I'm sorry for continuing on so much.
Please do.
I do love talking about this stuff because I don't think it gets enough airtime in the traditional world. I do think that it is this global network. If I think about for a second, like how much would it cost to build something like this from scratch if I were a company? There's no company that could build it. You know, there are tens of thousands of what are nodes and miners all around the world verifying transactions. Again, I don't want to get too much into the nitty gritty here because for people who are not versed in Bitcoin, it just gets confusing. You know, I will say that as I think gold has a place in a portfolio as an asset, I think Bitcoin does too, but it is part emerging technology, part store of value, part, you know, security network apparatus for the world. I mean, remember, Bitcoin is really important because it's never been hacked and it's a bulletproof security apparatus, meaning it is immutable. The ledger, the transactions on the ledger cannot be changed. It's there forever. In my sort of first interview on this subject about a year ago with Raoul Pal, I called it, and it wasn't me who coined the phrase, but a truth machine. And I think that in the future, you know, anything somehow that people want to make sure is 100% verifiable, 100% truthful, I somehow believe that it will be linked into this Bitcoin network. So again, I think Bitcoin is something absolutely huge, and we're really sort of in the super early days of it.
Yeah, I mean, we're going to get into the potential of digital broadly. It's not just Bitcoin, it's the ecosystem, including the blockchain and including what Ethereum and potentially how DeFi is being built on that. And the next most amazing companies in the world are likely to come from that. I get some families that say, yeah, it came out in 2009. I should have got in whatever early 11, 12, 13, but it's like too late now. And I'm like, too late? It probably is at the latest. It's the bottom of the first inning using, as you mentioned, Steve Cohen and the Mets, a baseball phrase. But I got a question for you. So there's about 200 trillion in bonds and cash that if inflation rises, and look at healthcare inflation, education, I think the government significantly underreports that this is going to earn near zero. So most institutional investors have about 30% allocated to that. Families a little bit more aggressive on equities, so maybe 20%, but that's 20% of their portfolio getting nothing. That they think it provides a level of security. In some ways it does. And we don't know, maybe there will be deflation. But you would have to think that allocating some of that, a third of that, and splitting it between gold and Bitcoin is just a logical thing to do.
Yeah, I mean, again, everyone has different risk appetites. Everyone has different portfolio requirements and needs. Splitting it is not a bad idea. 3-to-1, 4-to-1 ratio, also not a bad idea. Remember, Bitcoin is much, much more volatile than gold. You're going to see, 50, 100%, 100% moves on the upside, 50% corrections. They're going to happen. It's up over 200% on the year, and well, certainly up over 500% for March. So you're going to have massive corrections. Gold is not going to be as volatile. So you adjust the ratio based on what you're comfortable with. But I think that's exactly the point. That is the right point. And those bonds aren't, if you think in real terms, they're actually losing value. It's not right. Because there is some amount of inflation. And is it 1? Is it 2? Is it 3%? Someone like Michael Saylor, who's really stepped into the fold here in Bitcoin.
Of course.
Right. He's talking about 10 to 15%. I think he's just using basically money supply growth, which is not a bad measure, to be honest. Money supply growth, maybe there's some other things that he's factoring into that number. I wouldn't say it's that high, but look, you're yielding 20 basis points or 50 basis points. You're going to lose 2, 3, 4 percentage points at the very least annually. So, you think like over the next 5 to 10 years, that's a huge chunk of money just gone out the window. And do I think that gold will go down 25, 30, 40% over the next 5 to 10 years? Absolutely not. And so, and in fact, it could be a tremendous, buffer and hedge for your portfolio. And similarly, Bitcoin, I don't see any way that Bitcoin could have a 5 to 7 year period where it could go down that much. I'm just saying on a real basis, if you're losing 3 to 4% a year on a zero yield, right, you're going to get to 25, 35% loss. I just don't see it. I mean, Tudor Jones wrote a great piece in the summer that is available probably on the web somewhere, 8 pages, that takes you through the comparison between gold and Bitcoin from a purely global macro perspective. I think it doesn't really focus on so much the Bitcoin and blockchain technology aspect, but it is more on the perception of it as an asset from a macro perspective. That's really worthwhile reading. He calls Bitcoin the fastest horse, and I think it will be the fastest horse. But if you got a really large portfolio, you can't own enough Bitcoin. It's still, now it's a $450 billion asset. It's grown, will continue to grow. And maybe in the future, it does become something that institutions can easily buy, 10 or 15 billion in. Whereas gold, you can buy 20, $25 billion of gold, over a period of time. Not that difficult.
Well, then you kind of answered my upcoming question. I was going to reference, but I'll twist it a little bit, the Tudor Jones white paper. And you said basically that, yes, it does appear between the two, and you're a fan of both, that Bitcoin is going to simply be the fastest horse in the race, but short term could be volatility. So if you're trying to make a case for both gold and Bitcoin, yet Bitcoin appears like it's going to be the fastest horse in the race, why put anything to gold? Should it all go in Bitcoin if you have a long-term perspective?
Yeah, I mean, look, and there's some people who have done that. I think that, I think for especially large institutions, it's just physically impossible. It's still too small an asset to do that. And also, as I said, it's not really a defensive asset. I mean, it is a little bit. So, there's, as you mentioned, 200 trillion sitting in cash plus duration. And that all can't just go into Bitcoin.
No.
So I kind of think that there's, gold is something different. I do think it's a more pure defensive hedge. And I think, look, if you're an individual and you've got a lot of risk appetite, sure, you could take that portion and put it into Bitcoin. That would be fine. There's enough liquidity, but that's just not really practical for pension funds or life insurance companies. And again, we've seen Mass Mutual has $250 billion. They put 100 million into Bitcoin. That's not doing anything for them.
Yeah, 250 billion. So it's under 1%, well under 1%.
Yeah, it's tiny. And so maybe they get to $1 billion, maybe they get to 2 billion, maybe Mass Mutual gets to 5 billion. It's still not that big a deal for them. But in a situation where they're losing 25, 30%, let's say over a 5 to 7 year period in real terms on their bonds, you could easily move, 10% of that into gold. And so it's not, if you're telling me, yeah, you don't care about swings of 50 to 80%, like we've seen, if that's totally fine. And I think for many individuals, they have made that decision. But there's $500 trillion out there in assets. There's, as we just said, 150 to 200 trillion losing money on a real basis. Okay, at some point, and my view is that this is the decade for that. Over the 2020s, people will start to realize that this whole asset class has been, in quotes, as I say, neutered. And yes, individuals can decide that they can handle, that kind of volatility. And yes, I say and I've said this, Bitcoin can go up 20x and gold can 2x. right? And maybe gold can 3x, but gold cannot go up 20 times. It's just not, you know, and again, I don't think they're comparable, right? I don't, you know, I always say that they're cousins, that they have some similar attributes. But Bitcoin, you know, and investing in the companies in the digital asset ecosystem, the ones that are growing up with the adoption of Bitcoin, cryptocurrency, and blockchain technology is also something that I think has tremendous growth potential. And this Coinbase IPO is going to be very important coming up in the next few months for establishing value in the equity of the companies in the space. Because remember, there is Bitcoin, it is the discovery, it is the most important thing in the ecosystem. But you know, you have things like central bank digital currencies now. And of course, you mentioned Ethereum. There are projects in DeFi. There are all sorts of things going on in this world that will still be around. Ethereum is a $70 billion cryptocurrency. It is extremely complex. A lot of the projects that don't need the insane security that Bitcoin provides, you don't need 6,000 confirmations to buy a coffee, right? You know, if the Federal Reserve needs to send the Bundesbank $100 billion in 1 second for a cost of $5, they'll be able to do that across the Bitcoin network at some point in the future. So for transactions of very large value that need the security and want to pay for the security, it will all be Bitcoin. But there are all sorts of other interesting projects going on, you know, that are valid. You don't get to be worth $70 billion just because on some kind of, you know, speculative hoo-ha, you know, whatever. Ethereum, I think, is going to be with us. You know, the number of programmers, the number of smart people working on that platform has validity. Again, I don't focus on it as much because coming from the gold perspective, Bitcoin is a natural for me to understand. And then I understand also that, you know, the governments and the central banks and everybody else in the world knows that the digitization that's going to happen of things of value in the digital asset ecosystem, there are going to be many people and many companies, and there are now growing up and functioning in this world. And again, that's what my fund, 10T Holdings, we're focused on, the growth in the digital asset ecosystem. So, I mean, I think it's just, as I said, Bitcoin and the DAE are just something much bigger than just gold, which to me is an asset that needs to be in the portfolio. I hope I sort of made that clearer.
Yeah, no, that's great. And again, if we had multiple hours, we could really dive into a lot of that. This is just so great. We're getting a question in from one of the single family offices. I was going to ask you this question. I'll slightly tweak it. There are some that believe equities and Bitcoin are still somewhat correlated, whether I agree or not, and that it's hard to find uncorrelated assets. So his specific question: if we were to have another 20% stock market decline, how would you expect Bitcoin to trade this time? And were you surprised by how much Bitcoin went down in March?
Well, no, and that's part of the thing is that if the stocks go down 20%, there's no question Bitcoin will go down.
Right.
It'll go down a lot. I mean, I don't know if it's 20%. Look, it went down 20% the other night over the weekend, you know, just because. So, you know, it could go down 30 or 40% easily and not mean anything. I mean, I think the studies have shown that there isn't a great correlation between Bitcoin and the other assets. And that person at that family office can email me directly and I will send him the work that we've done. We have a panel in one of our presentations that lays out all the correlations. So I'm happy to send that to him. And it really does show that it's not really correlated to anything. However, given that, you know, you have Bitcoin on futures exchanges, okay, and there is leverage in it now.
Yes.
If you have portfolios that are leveraged, that are getting hurt, they will sell assets that have done very well. And my goodness, if you're a portfolio manager and you're worried about month-to-month performance, and you're getting annihilated on your equity, you're probably going to take some profit on your Bitcoin. And that's just the way it's going to be. I think gold also might go down. Of course, it depends exactly why the equity is going down. But I think gold goes down a lot less and comes back a lot quicker because it really does have that defensive characteristic to it. And so again, it's a different question. Remember what Druckenmiller said on CNBC. He's long Bitcoin because millennials like it as a store of value, and because the people in Silicon Valley value it as a store of value. And so, if the NASDAQ goes down 20, 30%, you can bet that big, and I think it's fine. You can bet it's going to go down quite a lot. But the way that I deal with it personally is I don't trade it at all. So I don't, I've allocated a certain percent of the portfolio and that's it. And I'm not trading it. I try not to look at it too much because I think eventually it's going to 300,000-400,000. It could do more, but I mean, that's sort of my initial target, sort of within the next 5 years. So I don't want to play around, even if it drops 50%. I mean, I'm not touching.
I'm going to ask you basically the most common questions I get. We're going to chuckle a little bit because, again, the penetration rate, even among single family offices, ultra high net worth families, per my research and surveys, it is still early single digits, which is what I mean. We're early in this game. The most common questions I get, and we're going to chuckle, is, okay, I think I'm ready to maybe do something. One, I say, do research and form a thesis, just like a macro trader like yourself would do. You asked me the easiest way to buy Bitcoin. To me, it's a no-brainer. It's Square's Cash App. It is so easy. But when you start to want to get real serious about it, you're likely going to go through an over-the-counter, an OTC, and you're going to want to store it in deep cold storage, NYDIG, Fidelity, Digital, Anchorage. Do your own diligence and own research. But if you had to help people say, how do I put my toe in the water and how do I feel safe about it, what would you recommend to them?
Well, no, you really hit the nail on the head. And again, if you're institutional type of client, and it depends what kind of toe dip you want. It depends what kind of security you really need. You mentioned some good things, like the Cash App is very easy and simple, as is PayPal. You can just buy your Bitcoin or Ethereum there. It's very easy. I haven't used that yet. Or Robinhood is also equally as easy.
Well, that ties you up a little bit, and Apple Pay is coming.
Yeah, I mean, look, again, and then you fall down the rabbit hole and you sort of realize, what you want. I mean, there are so many different ways to hold it, but if you want some, help, I think, Fidelity is a name, of course, everybody knows. And look, U.S. Trust just announced last week that they're going to offer custody services for Bitcoin and
Northern Trust. Yeah.
I'm sorry, Northern Trust. I'm sorry, Northern Trust. Thank you. Yeah. And my goodness, Northern Trust, that's 13 trillion in custodied assets, 1.3 trillion under management. That's a real company, if that's the kind of assurance you need. So, and then, if you want it in bearer form, you can I wouldn't touch Ledger now, but
yeah, let's not scare the audience that doesn't know as much.
Right. So, there are all kinds of ways to hold it. And, setting up an account, as you said, at Fidelity, a lot of people like the Grayscale Trust. Again, it just, I would say 2 years ago, or 3 years ago, that was kind of a problem.
Big problem.
But now it's not. And these entities are regulated, so you don't have shouldn't be much fear. As you mentioned, NYDIG is a new player. I've heard, done a great job. River Financial is a little more of a boutique service. Even Coinbase has rolled out a little more of a sort of boutique service as well. So,
Yeah, I mean, it's much better than it was, again, like 2 or 3 years ago. We'll segue a little bit into the bigger picture of the ecosystem, which you hinted at. And I'll circle back to forget what they say in the public, look at what they do and what they're building. JP Morgan, Goldman Sachs. One, they will absolutely get more involved in custody in the next year or two. Banks are going to be more ingrained. They're going to need alternative streams of revenue as central bank digital currencies start to come into play. They're hyper creative. They're not going to go away. They're going to adapt with the times. JP Morgan has over 100 people in their digital assets division already. But my bigger picture question to you is, what is the one thing that has to go right for the ecosystem blockchain to become bigger than the internet?
The one thing to go right, I mean, in my mind, it's already gone right, which is that it's a proven security apparatus, which is to say that the internet was invented, but it did not have a money protocol. Like, you know, the internet is used for basically exchanging information and email and back and forth like that, but there was no, you know, secure means established, and certainly no decentralized means for transferring value. And so, you know, I sort of make this funny quip that 30 years from now, we'll look back and say that, that the internet was invented for the purposes of being the basis or the base for the Bitcoin network. Right, so that in fact, you know, the internet was invented, but the security protocol wasn't there. And as you know, things are getting hacked all the time. Bitcoin is never getting hacked, but everything else on the internet is. So I think it's already gone right, and I think that may be sort of the difference in my view versus most people out there. I think we're already, you know, developed. It's already established. You know, it's already proven itself. And so, you know, someone who asks that maybe, you know, I think should maybe do a little more digging. But I have to say it's, you know, that is a general view, that it's still a little question mark over the entire sector, right? Like it's still not quite valid. But I don't see it that way at all.
And how would you look at, I mean, we mentioned it still is early stage for successful families and family offices to own even Bitcoin and doing it directly or possibly through a hedge fund or like the Grayscale Trust that you noted. But now we're talking about blockchain, stable coins, DeFi, NFTs. This is going to be a little bit above where some families are ready to go at the moment, but they need to do a level of research and thesis. Likely they may not be direct investors into that ecosystem, but there's going to be opportunities for them to invest alongside of professional investors. Do you see that just growing and scaling, and that's what's going to make this whole thing take off?
Well, you've given me a little, that was a little bit of a softball. Yes, no, but I do. And you're actually very right. You're very right, because I think the complexity inherent in Ethereum, and again, in some of the other blockchains, some will fall away and be zero. Some will be, you know, I think will be valuable. Understanding, you know, even Lightning, which is which sits on top of the Bitcoin network and is for smaller transactions. Understanding how these things work is super complex, and I don't think achievable, certainly by guys over 50 or 60. It's funny how age, you know, demarcated this space is. As I said, the average age is around 32, but there are a lot of companies that, and they're all private basically, that are growing up with the adoption, increased adoption, and that are companies, for instance, like Paxos, which is a blockchain, I would call it a blockchain technology company. They are the ones that built PayPal's functionality. So PayPal all of a sudden is able to offer their 340 million clients the ability to transact Bitcoin and Ethereum Well, who does that? Well, a company like Paxos built them that functionality. I think Paxos will continue to hook up the legacy world or the old world with this new digital asset ecosystem. And as I said, there are other companies out there, like Figure and Chainalysis, other exchanges aside from Coinbase, like Kraken, and you have companies like DCG that are really touching this ecosystem. They're very involved in developments in DeFi and projects that are on Ethereum. And if I'm a family office, I would look for a way to get exposure to some of those companies. And again, a softball, because again, that's what 10T Holdings, my company, is going to be focused on. People don't realize that there are at least 30 companies in the digital asset ecosystem that have a market value over $400 million. Again, there are hundreds of companies that are venture, that are in the neighborhood of $50 to $150 million valuation. A lot of them are early stage. I would call them more high risk. But there are a lot of companies that frankly, I think would be public if people weren't, so, concerned or still so nervous about blockchain technology, Bitcoin, and, how this whole digital world is going to develop. And for them, I would just say, if you just step back for a second, when you see the major central banks in the world, China, US, and Europe, coming out with digital currencies, it's got to tell you that there are a lot of other things that are going to migrate into this world. And there are going to be a lot of companies that are going to be, servicing those, companies in that space that are going to be helping central banks facilitate, different projects. So, in a pure pristine world, in the Bitcoiner mentality, there's only Bitcoin and there's nothing else. The reality of it is the entire rest of the world that exists today isn't going to just disappear overnight. They are going to migrate onto these new digital rails. And I think that's sort of the biggest macro opportunity I've seen in my career, biggest sort of the most asymmetric risk reward bet I've ever seen. Mm-hmm. And yes, I would agree with you that we're sort of in the bottom of the first inning.
I mean, sometimes when I'm asked, and I mentioned it in my white paper I wrote for family offices on Bitcoin and the ecosystem just this week, at the end of the day, 1% to 3% until you do deeper research and a thesis and get more comfortable, then possibly go to a higher level. But I want them to be a little careful. I'm getting a fair amount of questions, but I do want to be respectful of your time. Maybe I'll go round robin on quickly 2 or 3 of them. One person is asking, I think they read this in an investment letter that I saw this morning, the big vision for Bitcoin and cryptocurrencies is to replace fiat currencies. I'm going to say with central banks coming out with their own digital currencies, the governments are not going to allow that to completely happen. For Bitcoin to be successful, no, it doesn't need to be per se the fiat, the currency of a government. Would you agree, or do you think it has to dominate the world?
No, I mean, look, there's hope and fantasy and ideology, and then there's reality. And the reality is, right. And the reality is, governments and the world is still about people. People invented Bitcoin. Yes, I think Bitcoin is something of nature, but, people aren't just going to disappear. Governments aren't going to go to zero. I know many people are, some of the extremists are talking about a world with no governments. Look, I just think who knows what 100 years from now. I'm not really investing on a 100-year outlook. I'm thinking more sort of about the next 10 years. That's kind of my framework. And I'm very focused on and always on the reality of things. So yes, there's some guys out there saying Bitcoin has to take over everything and every central bank will only use Bitcoin in the future. That's just, in my view, that's not a reality. It may be a hope of a small subsection, but there are power dynamics involved. We are human beings. We do live in an existing system that is not going to go away overnight. And so, I think it's very important. I think that if you're a government and you've decided that you're going to, increase your money supply by 500% in the period of a few years, that currency should be worth a lot less. And, what will it be worth a lot less against? Well, certainly against Bitcoin, certainly against gold, certainly against things that have a limited supply. So I see Bitcoin as being sort of the pristine, as Raul called, the pristine collateral of the system, that it will be a measure against which other currencies potentially are measured against. And, some countries may not like that. I don't think that they have any choice in that matter. But look, there are also a lot of countries, and remember, this whole idea is really a global macro / also emerging market bet. There are many countries. Yes. There are many countries in the world where the monetary policy is terrible, where currency is depreciating rapidly, where people don't trust their authorities. There are countries like that probably will adopt Bitcoin because, and hopefully they adopt the right one, not like today I read that Tuvalu, this country in the Pacific, adopted Bitcoin Satoshi's vision. I don't want to even get it. It has no hash power behind it. I don't want to get into
right. I agree with you.
Right. But there are countries, that don't know how to manage their own monetary policy and that are small, for which adopting Bitcoin could make some sense. But I don't think the big three, 2.4 quadrillion of currency trades annually on the global currency exchanges. We've got about 5 to 6 trillion in cryptocurrency that trades annually. So you can see how small Bitcoin is compared to all the currencies in the world. So you actually don't need too much of a shift by some of those countries, right, to Bitcoin. But I mean, I don't see the U.S. or any of the major ones doing it. And I think it's a bit reckless of these guys because if they go too far, I think the real value of Bitcoin will be lost because people will start to fear it. And that's a problem. Like, we don't want people to fear it. I would like the US government to encourage, if they're going to be anyway, to encourage the adoption of Bitcoin, to encourage miners to set up shop here.
Absolutely.
Just like in the usage of the internet. Remember how you could use the internet and there was no sales tax for a while? In the early days, they were encouraging people to buy things online. I think, we should encourage the growth of that in this entire industry. Look, it's happening on its own. And a lot of the, people in this space are like, well, we don't need any government help. Yeah, that's true. We don't. But we don't want to have the government against us either, right? Because, it's really, and we want to keep them on side because we're all just people, right? And Bitcoin represents value, and Bitcoin was invented by a person or a group of people. And there is no world that I see without people. So it's businesses in the area, it's adoption of Bitcoin. And I just don't think we want to fall behind also.
No, and I would say, probably Japan and some countries in the Far East are ahead, but we're doing pretty good compared to some countries like the Netherlands and France that are archaic in some of their guidelines. You're going to drive away talented technologists and people, drive away businesses, drive away tax revenue. That's what governments like. Yeah. And I mean, as you know, the US Treasury came out with some proposed regulations, and I understand the maximalist. It's a little concerning and it's not great news, but I look at it on the positive light. It could have been a lot worse. This is kind of government complete acceptance. It's going to be similar to cash and banking guidelines or that banks have to follow. And I think you follow her too. This is going to be important. Incoming US Senator Cynthia Lummis in Wyoming is tremendously knowledgeable and an advocate. And we're going to start to see more and more of that among US politicians, which is good.
Yeah, and I think that's just the reality of it. I think the maximalists definitely serve a purpose, and they're important, and they're first principles guys. And look, and certainly, there's no one more important than Michael Saylor to the space. There are times where I think, he goes sort of beyond what is practical or realizable. But, like many of the early guys in the space, he has a vision. I think, he needs to push forward with that vision. I think he's right about a lot, and certainly about his entry. I just, there's some times where there's a move over into, what I think a much sort of longer term vision, 50, 100-year kind of view, which I think is still, unknowable. And, but look, he's done tremendous good to the space and brought Jack Dorsey in to have Square purchase Bitcoin on their balance sheet. So look, I just think it's the first step right now, as you say, early innings for us moving towards a more sort of digitized world. Angelo, I'd love to go on. I have another call. I wish I'd sort of scheduled more time for you.
No, it's all good. I'll give a quick announcement while I have you on the call. I will be doing a private, non-recorded for my members, qualified purchasers plus only in January with Dan, where we're going to talk about specific opportunities to invest in this ecosystem. He has a tremendous team, great research behind it. My members, again, qualified purchasers plus, stay tuned, more to follow. Dan, you've been great. I'll wrap up myself the next 2 or 3 minutes. You could go. Look forward to seeing you again in January.
Thank you very much. Really enjoyed that, Angelo. We'll be in touch.
A pleasure. And everyone else, I'll give a little bit of a close. And I know that Dan would agree with this because I saw a retweet on his Twitter page. Really one of the common questions I get, we all get, is why does Bitcoin have value? I love the work of Jeffrey Tucker of the Institute for Economic Research. I'll briefly read it. It's a short paragraph. Bitcoin is both a payment system and money. The payment system is the source of value, while the accounting unit merely expresses that value in terms of price. The unity of money and payment is the most unusual feature, and one that most commentators have trouble wrapping their heads around. There's more, but look it up online. Again, Jeffrey Tucker, Institute of Economic Research. If we had more time, we would dive into the intrinsic value, which a lot of the people on the other side of the fence are wrong about, but it's good to listen to all points of view. We have Jim Rickards coming on. We know he has a different point of view in early January. Earlier this year, I had my friend Peter Schiff on. He has a completely different perspective. Let's not be closed-minded to either or, and be open-minded and listen, because again, this is a new world order relative to, I think, what's going on in digital, which is why I've been so active in it, from programmable money, central bank digital currencies, and all the ecosystem of this community, more than just Bitcoin and crypto, but blockchain, stable coins, DeFi, NFTs, et cetera. So it's been great to interview some of the true thinkers and thought leaders like Dan, Lynn Alden, Raoul Paul, upcoming Robert Breedlove, who's great and is a maximalist, and the people that will be on the other side of the fence, like Jim and Peter Schiff that I mentioned earlier. So it's going to be a lot of fun, a great ride. I look forward to being active in this community, especially representing kind of the single family office side. So to me, it's been very intriguing. In my little bit of a wrap up, I'm Angelo Robles. I'm the host of the Angelo Robles podcast. You could find us on Apple and Spotify. I also have a pretty prominent and growing, thankfully to many of you, my YouTube channel, which simply is Family Office. We're probably going to start to put less and less videos on there, but we'll have some. But we are, and I'm the founder and CEO of Family Office Association, a global membership organization, besides on YouTube and other social media platforms that are free, and just follow us there and interact, or my podcast. But my members get specific value in our exclusive content, opportunities to participate live in our many, many digital programs. And we're still doing small physical workshops. And as the vaccine rolls out and things look better, second half of 2021, we have big plans on both coasts for some really special events. We also consult and advise families creating an SFO, adapting during the challenging times technology perspective. So we're incredibly active. Look us up online. We're familyofficeassociation.com. It's very easy to join and really be part of a very special community. My direct email is angelo@familyofficeassociation.com. And speaking a little bit from Dan Tapiero's behalf, one, he's great. I look forward to having him on again. And for those of you that you really have to be preferably a member, but a single family office. I might be able to make a connection to Dan. He didn't have enough time to go into a little bit of that, but simply just reach out to me and I'll be able to make that connection. And again, I will be doing a private non-recorded session for my members that must be qualified purchasers plus on really a deep dive investing into that ecosystem. And that's coming up around the same time I have Jim Rickards. So it's coming up in relatively early January. So that's not that far off. Everyone, it's kind of late December of 2020 now. You may watch this or hear this in the future. Things in this community are changing so quickly. Anything relative to investing, be careful, do your own diligence, understand your risk, your time horizon. I would allocate only a small percentage, and I would go into it thinking, let's be a little negative, you may lose everything. It may all go to zero. You're going to have to form your own thesis about this, but I would just be careful. Again, everyone, I'm Angelo Robles. Thank you so much. We hope you enjoyed it and look forward to the next time. Thank you.